Inflation, it's a hidden tax. Don't pay it. If you're keeping your hard-earned savings in cash, it's losing value at a faster rate today than it was a year ago, thanks to higher inflation. Of course, you'll want an emergency fund in cash, but with the rest, you can hedge against inflation by investing in some of the world's best companies. You can become a co-owner. There's a list of companies that continue to pay investors more each year. These are some of the best dividend stocks around. As inflation picks up, these dividend stocks can help you hedge against rising costs. As food, housing, and gas prices continue to climb, these companies can push along higher costs to customers. Now, these companies, they do have to pay more to make, transport, and sell their goods, such as paying higher employee wages, but their sales climb as well, and the companies continue to profit. In other words, these companies, they have strong pricing power. This ability to push along higher costs to customers, it's great for investors. So without further ado, let's go ahead and dive into some of the best dividend-paying companies based on current market prices. Coming in at number 3 is Verizon, ticker symbol VZ. There's a huge investor that's recently bought into this company. Coming in at number 2 is 3M, ticker symbol MMM. And now my favorite dividend paying company today, it's Intel, ticker symbol INTC. Each of these dividend stocks is a little different, and I'll show you their dividend history, current dividend yield, and dividend safety, as well as some other brief highlights. I'll show you why they've landed on the top of my buy list. I've personally invested in each of these companies, and I've recently doubled down on my Intel position. For a little perspective as well, if you invest $100,000 evenly between these companies, you'd collect $3,917 in 2022. And that number should climb in the years ahead. You can set up a steady stream of growing income, and it's truly passive. You don't have to do anything to collect this income. Now, before diving into these top income opportunities today, I'd really appreciate it if you just tap that like button down below, as well as subscribe, because that really helps out my small YouTube channel. This is just a side passion project which consumes quite a bit of my weekends. So coming in at number 3 is Verizon. This company, it's a household name, and it continues to see stable growth. The company has taken on a lot of debt, but it easily has the cash flows to make its debt payments, as well as reinvest in the business and continue to reward shareholders. Its current dividend yield comes in at 4.65%, and it has a low payout ratio of 49%. Here's a look at the annual dividend growth over the past 10 years. It's up just over 30% and close to 3% on a cumulative annual growth basis. But if investors reinvested those dividends, they would have been seeing higher returns, a growing pile of passive income. For a huge stamp of approval, one of the world's best investors bought shares of Verizon in late 2020. Warren Buffett, via Berkshire Hathaway, he bought an $8.6 billion stake. That easily puts it within his top 10 publicly traded holdings. Based on Berkshire's 13F filings with the SEC, we can see that Warren Buffett bought in at around $59.24 per share. And at the time of putting together this video, Verizon stock last traded at $55.11. That means investors can buy in at more, or roughly a 7% discount to Buffett's buy price. That's also ignoring some dividends he's collected over this time. You can simply get a better deal than one of the world's best investors. Of course, anything can happen to Verizon shares. Warren Buffett, he's made plenty of mistakes over the years. Although, on average, it'd be foolish to bet against him. And as always, it's good to diversify. That brings me to the second stock on this list, and that's 3M. This company might not be as well known, but its products definitely are. It produces roughly 60,000 different products and has great pricing power around the world. It generates roughly 50% of its total revenue from outside the Americas. And you can become a co-owner in this great business. Now, you're not going to see rapid growth from 3M, but its slow and stable growth, it's hard to beat. Its dividend yield also comes in at 4.06%. The recent payout ratio is just below 60% at 59%, and it should be very safe in the years ahead. So here's a look at 3M's annual dividend growth over the past 10 years. It's increased at a much faster rate than Verizon's dividend. It's up close to 170%, and that's over 10% on a cumulative annual growth basis. Over the past few years, though, growth has slowed. 3M is playing it safe with some uncertain litigation risks and other short-term pressures. Although 3M's financial position is pretty darn solid, and it should be able to continue rewarding shareholders for many years to come. There's a high probability that dividend growth will pick up over the next decade to continue outpacing inflation. Now, for the number one spot, that company is, as mentioned, Intel. And it does have the lowest dividend yield of these top dividend stocks to beat inflation. It comes in at 3.04%. Although it is one of the strongest companies financially, and the dividend payout ratio has come in below 30% the past few years. On top of that, Intel, it also has some of the best growth prospects. So here's a look at the annual dividend growth over the past 10 years. Intel's dividend growth is up 78%, and that's close to 6% on a cumulative annual growth basis. We won't likely see huge bumps in the next few years, but long term, its dividend income should easily outpace inflation growth. If you've been following the semiconductor industry, you'll know that Intel, it's lost some ground to competitors. Although there's a new CEO at the helm making some bold moves, and this really isn't your typical MBA CEO. Instead, he is a proven engineer that's helping put Intel back on the map. The man with the plan is Pat Gelsinger, and he's ramping up spending at Intel to expand. We're going to see higher OPEX and CAPEX, or higher expenditures, over the next few years. As a result, profit margins will be lower. But even if some of the new projects, they don't pan out as well as expected, Intel should still continue to grow and be able to reward shareholders. As always, I try to follow the trend lines and not the headlines. I'll link to a video on why I'm investing in Intel versus AMD in the comments below. Overall, these dividend stocks come from different sectors. They provide some diversification benefit, and they should be able to continue boosting their dividends each year. To counter inflation, these dividend stocks should be a great way to go. I've personally invested a good chunk of my life savings into each of these companies. And if stock prices drop further, I plan on buying more, and also assuming that the fundamentals don't change. Now, going one step further, for a deeper look at why I bought into these companies, you can go ahead and check out these videos. I'll link to them in the description below as well. Also, what are your favorite dividend stocks based on current levels? If you had to invest or buy into a new position today, go ahead and let me know in the comments below. And thanks for stopping by.